No, we've done the front of the page, which gave us all of this information, so all of their earnings, and we've done their adjusted gross income because we took out their educator expenses and their moving expenses. And now we want to see if they should itemize or not. Now, if you recall, I said we look at this number right here. This is your standard deduction.
So you should probably know the value of your itemized deduction before
You have to, yeah, you have to go ahead. Ideally, what you do is, yeah, but you can do the worksheet, the Schedule A, which is what we're going to do here in a second, whether you file it or not, right? So you would do the Schedule A, see what the total is, and then make the comparison. Itemized? Itemization is where you list out all of your possible deductions. So all of those things that I talked about that are possible deductions include medical expenses, alimony paid. Oh wait, the alimony came on the front, sorry. So medical expenses, state and local income taxes, real estate taxes, personal property taxes, mortgage interest, mortgage points, mortgage insurance premiums, investment interest, gifts to charity, casualty, thefts and losses, unreimbursed employee benefit expenses. Like there's this whole list. If you know for a fact, no, kids are not deductions. Kids are exemptions that gets accounted for up here. So if you know for a fact you don't have more than 11,000 in those kind of expenses, for example, let's say you didn't have any of those expenses except maybe a couple visits to the doctor that was like a couple $100, then you wouldn't have to fill out the Schedule A. Like if you knew you didn't have the itemized deductions, you don't fill it out and just claim your standard deduction. But if you're on the fence and you don't know for sure, then that's when you want to fill out this form here, the Schedule A. And this is how you itemize your deductions. And so we need to go through this form now to see if the O'Sullivans should itemize or take their standard. Okay, so we start with medical and dental expenses. If we look over here, they had $18,800 in medical expenses. Medical insurance covered 80% of all of these expenses, so they only had to pay 20% of the medical bills. Okay, so we first have to take that $18,800 and multiply it times 0.2 to find out how much they actually paid. Because you can't deduct what you didn't pay, you can only deduct what you actually paid. So we're going to take that calculation there. So they paid $3,760. Okay. Any questions about that part so far? Now we're going to take that 3,760 and that goes right here in box 1. Okay. Then the next line says enter amount from form 1040 line 38. So we go back to our 1040 line 38, which is on the top of the back page. This is the adjusted gross income. So we list that. So far, all right? Multiply line 2 by 0.075. Oops, I put that in the wrong space. Sorry about that. For some reason, in my head, that was line 2 because it came below line 1 and I didn't look at the numbers. So I take that 77012 and I multiply it by 0.075. And this is what goes on line 3. So it's 577590. You're only allowed 577590. Here, you know what, I'll just do another form. Sorry about that. So we have the 3760, the 77012. This is the 20% that they paid to the doctors. This is their adjusted gross income. This is their adjusted gross income times 0.075. You're only allowed to claim, the way the medical and dental expenses work is you're only allowed to claim any amount that's over 7.5% of your income. So if 7.5% of your income is more than your medical expenses, you can't claim any of them. So since this amount is larger than this amount, they can't claim any medical expenses. If this amount was smaller, then you subtract and then you put whatever that amount is in here. Okay, so let's make it easy, 10%. Let's say I make $20,000. 10% of 20,000 is 2,000, correct? I'm only allowed to claim however much my medical expenses were over $2,000. So the first 2,000 I can't claim. And then any amount over that I'm allowed to claim. Well, for them, the 7.5% of their salary is $5,700. But they only paid $3,000 in medical expenses, so they can't claim anything because they would only be allowed to claim whatever was bigger than this.
Like
if it was 6,000, then they'd subtract and claim whatever the difference was. It makes sense now? So you can only claim that amount over. So the government basically says the first 7.5% of your salary, that's expected that you should have to pay that much. We'll only let you deduct whatever's more than that. Okay, so for this, there's 0. So then we're going to look at taxes and see, did they pay any taxes? So we've got $3,298 in state income tax right here. And then $3,567 in real estate tax. And $3,096 in mortgage interest. So state and local tax goes right here. They paid state income tax. So that's here. So you block that box, check that box. And we want to put in the 3,298. Now, general sales taxes. Every purchase that you make, you pay sales tax on, except for groceries. Right? If you keep every receipt for every single purchase you make for an entire year, you are allowed to add all that up, because those are local taxes, and put it right here and combine it into this line. You're allowed to deduct sales tax.
So like if I buy a shirt?
Yeah. You're allowed to deduct your sales tax. Since we don't have a local income tax, we have a general sales tax. So you're allowed to, you would check this box instead. And if you save up every single receipt for every single thing you purchase for an entire year, you have to have every receipt because you have to be able to prove it.
Does it have to be like all or no receipts? Like do you have all receipts?
No, you can deduct, if you have some of your receipts, you can deduct that. But the problem is, the standard deduction, guys, the standard deduction is $11,000. You probably, if that's the only deduction you have is sales tax, it's not going to be anywhere near $11,000 unless, hold on. Unless you spent $170,000 shopping this year, your sales tax is not going to be that high.
Well, I guess I'm gonna be
But you can do that. I just wanted to let you know you can keep all of your receipts, add up all of the sales tax from every receipt, and put it on this line. No, you can. Actually, you don't have to deduct anything ever. The government would prefer you didn't deduct because deductions lower your tax bill. right? So they don't, if you never deduct anything, they're totally cool with that. So you don't have to ever do any of that. It's a choice as to whether or not you want to do that. But I'm just saying that is an option. If you don't pay state income tax, you can deduct your sales tax. So that's a choice that you can make yourself. Real estate taxes are deductible. We have $3,567 in real estate taxes. Those go on line 6. Personal property tax. Property tax is not on here. Personal property tax is like taxes on the land that you own or buildings. Other taxes, we don't have any. They've got mortgage interest, but that's not a tax. Okay, so no other taxes. So this is 0, this is 0. We're going to add these two up and put that right here on line 9. So far we've got $6,865. Okay, mortgage interest and points reported on a 1098. If we go back, they have $3,096 in mortgage interest. Okay, home mortgage interest not reported to you on a 1098. If paid to the person from whom you bought the home, see instructions and show the person's name, identifying number, and address. So this is if you do like owner financing, like you buy a house from an individual and they carry the financing, because that does happen, and you pay them interest, you have to put their information here so that it can be verified. Banks are legally required to send you the 1098. So if the bank doesn't send you the 1098, you can go down to the bank and be like, oh, hey, I need my 1098, and they have to give it to you. But a person doesn't have to, so if you do like owner financing or something like that, then you'd fill out this information with their information. But we didn't do that, so. Okay, points not reported to you on a Form 1098, and then you'll see instructions for special rules. There's a whole, like a booklet, kind of like our tax table of Schedule A instructions. You won't have to worry about this unless you have a mortgage, at which point then you'll know about what this is. Mortgage insurance. We didn't have anything on here about mortgage insurance, so I'm just doubling checking, so no. Okay, now mortgage insurance and homeowner's insurance are two different things. Homeowner's insurance protects the home and the valuables inside the home in case of like a fire or a flood or storm or vandalism or whatever, theft. Mortgage insurance is for if you become disabled or if you should pass away and the mortgage was in your name. The mortgage insurance will pay the mortgage up to a certain amount, so that, for example, so your family doesn't end up homeless if you're the person that was paying for everything, and like you're the whole sole supporter. The mortgage insurance covers the mortgage payments so that the house doesn't get foreclosed on just because something happens to you. So they're two different things. So we didn't have that on there. Investment interest, that was not on there. Investment interest is interest you paid, not interest you earned. So this is not like dividends or anything like this. This is if you're paying interest to somebody that has invested in you, I guess. Okay, so we'll add all those up. That was pretty easy. Any questions so far? Okay. Gifts to charity. Charitable donations are the other thing that is deductible. So they gave $987 to different charities. The highest amount they gave was $100. Okay. So 987 goes right here. This is cash. Now, if you make anything, like if I donate $250 or more to any one single charity, there's another form I have to fill out. Okay. This is another form. There's lots of forms.
Yeah, cover all the bases.
Yeah. But you can have higher than $250 here as long as no one individual donation was more than $250. Does that make sense? So the problem had said none of them were more than 100, so we're okay. We don't have to fill out that other form. And then this is all cash or check. If you did something other than cash or check, for example, you donate clothes to the Goodwill, that's deductible. You have to have the receipt, so you can't do the drop boxes on the side of the road and deduct it. But if you take it to the actual Goodwill store and give them a bag of clothes, and they'll say to you, you say, I need a tax receipt. They'll say, well, how much is the bag of clothes worth? And you say, however much the bag of clothes was, like, how much did you pay for these clothes?
If you remember.
Yeah, or you guesstimate, like you say, okay, it was like 4 pairs of jeans and 6 shirts, like $100. You know, I mean, whatever. And so then they give you a receipt for the donation of $100. But you have to do that in person. You can't do the drop boxes. But anything like clothes that you donate, furniture that you donate, people that, you know, they see those signs for donate your car, donate your RV, donate your boat, all those donations that are physical items, those go on the next line. So they gave $450 worth of old clothes to different charities. So that's right here, other than by cash and check. If they do 250 or more, you have to do another form or see the instructions. And then this one, if your donations, any single donation is over 500, you have to fill out this form. These are for people that are doing that donate your car, donate your boat to the charity kind of things, because usually they give you the blue book value of the car, which even if the car is not running, they'll write the blue book value down on the gift receipt, and that's usually more than 500. Okay, carryover from a prior year. If you made donations, let's say in 2013, but you don't have enough deductions to itemize in 2013, but you think you'll have enough deductions to itemize in 2014, charity deductions can be carried for 1 more year. So anything I donate in 2013 and 2014 could be combined. That's the only thing that can be carried over is charitable donations. So you have like kind of like 2 years to report those instead of just the 1 year like normal. But we don't have any of those. So we're going to add these two numbers together. And put that right there. So that's a 7, 1437. Okay. Casualty and theft losses, you do have to attach another form, lots of forms. This is if you're robbed, if your house burns down, if your car burns down, if there's a flood, like any kind of property losses. Those go here. They had $9,230 worth of flood damage that was not covered by insurance. Now see, here's the thing. If you have homeowners insurance, you can only claim the losses that were not covered. So let's say you have $20,000 property coverage on your homeowner's insurance, which is incredibly low, but I'm trying to make it easy number. So $20,000, and you have a $30,000 loss, you can claim $10,000. You can't claim the $20,000 that the insurance company gave you. So their $9,230 goes right here. Okay. Any questions so far on any of this?
ABC is really easy and straightforward. You just need.
Yeah, I mean, there's other forms that you have to fill out, but the instructions on the other forms are much like these instructions here, where they tell you exactly what to do line by line. And every single form has like a pamphlet that you can pick up or look up online or download or print or whatever, that gives you line by line, like a paragraph on how to do this, a paragraph on how to do this, a paragraph.
Something like send you a booklet.
You can get a booklet, yeah. It's the same thing, but it's like every single one of these numbered lines has like a whole paragraph or two devoted to explaining how to do it. They're trying to make it easy because they want you to do it right. Okay, so okay, so here we have unreimbursed employee expenses. So let's see if we have any of those. Expenses for job travel, not from driving to work. Okay, driving to work is not tax deductible. Like commuting to and from work, not tax deductible. However, if you have to, let's say your employer wants you to go on a conference and you have to drive from here to, like, say Miami to go to this conference, that drive is deductible. If you have to buy a plane ticket and your employer doesn't pay for the plane ticket, like you have to buy the plane ticket, that's deductible. So any kind of extra things that are not just driving to and from work every day, that are unreimbursed job expenses that you have to pay for, those are deductible. And so here you've got job travel, union dues, job education, etc. A lot of people can do this one. That's probably the most common, union dues. And then, like, if you have to take a class or certification for your job, this can, oh, I'm not on the right page, sorry. So union dues, job education is the next thing. So, like, if you have to take a class or certification, you can deduct that cost or that tuition. Anything that you have to buy for your job that your job doesn't pay you back for, but that is required for your job, other than commuting to and from work. If your job requires you to have a uniform, but they don't pay for your uniform, that is an unreimbursed employee expense. So that also counts. Okay.
You know if that counts for military?
Military is a little different. I'm not really sure how that works with military.
Those ones are expensive.
Yeah, I have no idea exactly how that works with military.
They're tax-free by themselves. It depends on where you buy them on base.
If you buy them on base, but after boot camp, you're required to.
Okay, so Brian had $541 in expenses for job traveling. And they have union dues. And he had college tuition. All of these go on the same line because they, if you look at that line, it says unreimbursed employee expenses, job travel, union dues, job education. There's another form that needs to be filled out, but we're going to add these together. So we have 541. I'm going to write it on the back one. 541, 1439, and 2315. So those are the expenses. We're going to add those together. Those are unreimbursed employee expenses. Those go right here. Also, like if you have a job that you would take conferences for, like teaching, for example, requires professional development to maintain your licensure. And schools will provide a certain amount of professional development for you that they pay for, but it may not be enough hours of professional development to maintain your license, so you might have to pay for some like on your own. Then you can turn around and tax deduct it. So it comes out like that you're almost like you're not paying for it because it gets deducted. So it kind of works out. Tax prep fees. This is not for this year. Okay, so if I'm filing my 2013 taxes right now, which today's the 15th, so technically they're due today. They actually postmarked today, and I pay somebody today, I cannot deduct those fees until next year because I'm paying them in 2014. So they are part of my 2014 taxes. So this is from the previous year. So if I paid somebody to file my taxes in 2013, I would put that on my 2013 tax return right now in 2014. Does that make sense? Okay. Let's just check. Did they have? Nope. They did not pay anybody to do their taxes because they took my class, and so they didn't have to. Okay.
Save money.
Yep. And this can range from like $30 if you do TurboTax online to like $400 to $600 if you hire a CPA. I used to think H&R Block was only ever $60, but I have a friend that just went to H&R Block and had to pay $300. So it depends on your situation. It can range anywhere from $30 to $600 to pay for taxes to get done.
But it comes off, like.
You can deduct it the following year. So, like, you pay for it now, but you can't deduct it until next year.
That was kind of free.
You have to wait a full year, though.
You wouldn't save $300 in taxes.
No. Well, maybe. It depends. Okay, other expenses. If you have investments, safe deposit boxes, etc., there's in the booklet they'll tell you what is acceptable here. Yeah.
Remember when you said overrides, we gave those people cards, right?
Yes.
Did they deduct it on this thing?
No, they're not deductions. Those are income. Yeah, that's where you got that. You know how she won the lottery, and we had to put the lottery in there. That's where the car would have gone.
It's a deduction for her, though.
Yeah, it's a deduction for her, and then it's a tax increase for everybody else that won one.
Yo, Oprah did that on purpose.
I don't think she did that on purpose. Okay, you add these lines together. Okay, and then Form 38 line, or 1040 line 38, the same thing that we put up top was their income.
The lottery thing was like, my stepdad won like $10,000 on a scratch off one time, but he told me that after taxes it was only like $7,000.
Yep.
So then would this like give back the other person?
No, the way it would work is he would put the 7,000 or the 10,000 on that line of his winnings, but when you do the taxes paid, the 3,000 that got taken out that he already paid into taxes goes into the taxes paid part. So you'd already paid the taxes on them from that one because the state does that. They take the taxes out for you. So he wouldn't probably end up owing any more money, but he probably also wouldn't get really that money back either. We have to take, for job expenses, you're only allowed to claim whatever's over 2%. So we take that 77,012 times 0.02, and we get 1,540.
Over 2% of like your own income?
Yeah. So it works the same way as the medical expenses. Medical expenses are 7.5%. You can only claim whatever's over that. With job expenses, it's 2%.
That's like with the classroom decoration or something?
No, this is the traveling for your job or having to buy uniforms for your job or paying union dues, that kind of thing.
So they can deduct.
Yeah, they will be able to deduct. What you do is you take the $42.95, you subtract the $15.40.20 from it. And you get $27.54.80. If you subtract these two lines and you get a positive number, it goes here. If you subtract these two lines and you get a negative number, you write a 0 here. That's how that works. Okay. Other miscellaneous deductions from list and instructions. If we look at the instructions, hold on, I'll pull that up. Let me pause this. Okay, so these other deductions are going to be 0. We're going to add all of these up down the side. So I'm going to zoom out.
It's very obviously over 1,000.
Yes, it is, but we need to know exactly how much. Hey guys, to show that I'm having to add all of these all the way down the line. So I'm going to go down the line. I'll zoom in a second, but I got 0 plus 6865 plus 3096 plus 1437 plus 9230 plus 2754.8. Okay, and my total If I did that correctly?
I'm not in this.
Oops, 33A2. Okay. Now we wanted to see if it was over 11,000. Should they itemize or should they take the normal standard $11,000 deduction? Itemize, right? Now that's what you do. You fill this paper out. It's not that difficult. It takes a couple minutes. It takes us longer because I'm talking about it. But if you just went through and filled out the information, it takes maybe 5 or 10 minutes. You fill it all out, and then you compare. We have $23,382. That is better than $11,900.
So if you did that and then you found out that you could only deduct like, I don't know, $5,000, you could just deduct the $11,000.
Yeah.
How
So
does that make sense?
once you fill out this form, this form, Schedule A, just because you filled it out does not mean you have to turn it in. If you use it, no, not to me, to the government. Okay, if your schedule, okay, so let's say you did your Schedule A and your total's $5,000, which is less than your $11,900 standard deduction, right? So you want to take your $11,000 deduction, not your $5,000 deduction. So you take this form and you crumple it up and you throw it away. No harm, no foul.
And then you get $11,000?
No, that's your deduction. You don't get it. It just gets deducted from your income. Yeah. So like you fill this form out, you get to deduct something no matter what. You have the standard deductions here. It's their way of adjusting tax bills to even things out. There's a reason that I don't know. But so you have your standard deductions here, your itemized deductions here. If this number, guys, shh, please, it's rain. It's Florida. Yeah, I better be used to it. It happens like every day from May till October. Okay, so my $23,000 was higher than my $11,000, so that's the number I'm going to put here. Because I'm keeping this form, because I'm using it, I have to take this form and the Schedule B that we filled out, and when I submit my taxes, if I'm submitting them by paper, I staple these all together. Okay? So, what do we do with the deduction? We subtract line 40 from line 38. So 38 minus 40.
Can I turn away?
Yeah.
And there's only one light switch.
Yep, all or nothing. All right, so we subtracted, right? So you subtract from your income your deductions. That's how deductions work. They lower your incomes. Deductions lower your income, credits lower your tax bill. Okay, so deductions get subtracted from your income. Tax credits, which we haven't gotten to yet, get subtracted from your tax bill. So right now we're still in income. Okay, exemptions. You multiply 3,800 by the line on 6D. 6D tells how many people you were claiming. 3. So we're going to do 3,800 times 3. You get $11,400. And then you subtract that again from the number above it. So I do 38 minus 40 to get 41, and then I do 41 minus 42 to get 43. Okay, so our income has been reduced from our original 80,000, right, to 42,000 using our deductions and exemptions. Okay, so now we have to look up our tax. That comes from the tax table. Tax table. And we're looking for $42,000. So we're going to go to page 84 in the tax table. 42,200. So that is right here in this row. And they're married filing jointly, so their tax is 5,464. I don't know if you guys can read that. Can you read that?
Yeah.
Okay, 5,464. Okay. Alternative minimum tax, we're not going to do that. So we add these two lines together, and their tax is still 5,464. Okay. Foreign tax credit we don't have. Credit for child and dependent care expenses had not been mentioned in the problem, so we're assuming they didn't have those. Oops, wrong thing. Okay, let's go over here. Exemption, okay, that was old, so that was 3,500. It's actually 3,800 now. Okay. Oh, they did. They paid for childcare while they work, so they can get $780. There's a form to fill out.
That's 48, right?
Yeah, so $780. Let's look over here. They installed some energy savings items in their home, and they can receive a $133 tax credit for that. On the example 10, after the $780, yeah. So we come down here, no education credits, no retirement, no child tax credit. Residential energy credits, 133. There are certain things that qualify for this, installing like solar panels on your house, certain appliances upgrades, certain upgrades of like things like insulation and windows and stuff like that. And when you purchase those things, the people that sell them to you can let you know if they're applicable for the energy savings tax credits. Okay, we don't have other credits. 780. So we're going to add the 780 and the 133. And we've got $913 in tax credits. Tax credits get subtracted from your tax bill. So we're going to take that tax bill of $5,464 and subtract the $913.
Rita, do you want to make another test?
Yep.
Oh.
Okay. Now we get into self-employment tax. You'd have to attach a Schedule SE. They're not self-employed, so we're not going to worry about that. Unreported Social Security and Medicare tax, not there. Additional tax on IRAs, we're not worrying about that. Household employment taxes. Okay. If you are employed in a household, like or if you employ, either you are a maid or like you hire a maid, but something like that, like a lawn garden, like people that work in a household instead of like at a normal job. First time home buyer credit. This, if you're buying your very first house, you should get this and you have a form. Other taxes we're not going to worry about, but there's instructions, so we're going to add these all up. $4,551 is their tax bill. Okay. So.
Question.
Yeah.
Never mind, I answered it.
Did I not give the tax on the W-2?
Why would you pay someone so much when you do this for them?
Because people don't know how to do it.
People don't know how to do it. Here's their taxes. Okay, well, apparently I did not say what their tax that they paid was, so we're just going to say, I'm going to go back and do what that probably would be, so 80,000 154 times 2020. Okay, that's about 20, not quite 20%. 15% of their income. So we'll just say that's how much was taken out of their checks. I'm making that up. Okay, so this is how much was taken out of their checks because I just made it up. If you applied any of your prior year tax return to this year's taxes, that goes here. If you received the earned income tax credit, now this is based on income and having a child. At $80,000 with 3 people in their family, the O'Sullivans would not qualify for that. If you look at the Form EIC, it tells you what the income restrictions are, and I believe for a family of 3, it's around $40,000. So you have to make less than that. Combat pay, non-taxable combat pay election, we don't have that. Additional child tax credit, we're not going to have that. American Opportunity Credit, amount paid with request for extension to file, excess Social Security. We're just going to get rid of all of these and say that they paid this much. Okay. I made it up.
Why?
Because it wasn't in the problem, so we needed something, so I made it up. It's a little bit over 15% of their income. About 15.5%. Most people end up paying about 20 to 25%, but I went a little low. Okay, if this number is bigger than this number, you get a refund. If this number is bigger than this number, you owe money. So do they get a refund or do they owe money? They get a refund, right? So we're going to take that $12,435.42 and subtract $4,551. And they're going to get $7,884.42 back. Okay. At which point you'd fill out like this information on your bank account if you wanted to direct deposit it or whatever, and you have to sign here, and your spouse has to sign. You both have to sign, and then you submit it. You submit this tax form, the Schedule A, the Schedule B, and copies of your W-2s and 1099s or 1098s. And then all these other forms that I circled, those would have to be attached also.